of value because they do own some real assets. And there's so much money printing. That's why gold is going up, silver is going up, commodities are going up, and therefore stocks are remaining levitated because they have title to real assets. And that's kind of in a hyperinflationary scenario. We don't think that's the case. I can see that occurring down the road, but I think we're a long way from that. I still feel like the issues for the next few months at least are in deflation before we get to inflation. I think we have to have a significant decline in the market where hope is dashed. Kevin Duffy and Bill Lagner from Barron Asset Management, you've had Bill on the program before, has talked about sentiment and how we've had the biggest change in sentiment from negative to positive over the last 6 months than we've seen for any time in the last 30 years. Some of these reasons require that this market decline substantially.
Just so listeners can understand this, David, if you go back and look at the period of time right before the Great Depression started and compare that to today, right now, aren't we in far worse shape today, right now today? Forget the stock market, the bounce, and how that affects psychology, because everybody felt differently in March, right, when we were getting creamed. Aren't we in far worse shape today than we were as a nation back then, forgetting the noise of the stock market?
Well, I'm not an expert on that history, Eric, but I can say that we borrow far more from foreigners. We have a much greater debt level at the consumer level. We have far greater excess capacity in consumer infrastructure. And also we have individuals that are far more fat and happy, I'd say. I guess you can say literally from the obesity statistics as well, where our people are softer, I believe, and less able to deal with adversity. As far as on the foreign front, we have some real problems on the foreign front in terms of this Iranian-Israeli situation. We have more threat of terrorism than we had in the past. I'd say America is more unloved relative to the rest of the world than we were before. We do have some systems in place in terms of guarantees, FDIC, unemployment insurance, so some people would argue that we're better off. However, we are at risk of a currency crisis whereby those guarantees may not, we can print money. The question is, how much will that money be worth? So it's a completely different scenario.
A lot of people don't follow the technicals. I don't know if you do over there, David, at the Federated Prudent Bear Fund, but when you look at the dollar and the fact that it broke multi-decade support at around 78 to 82, and you know we've just been wallowing around as we speak, I think we're around the 76 level, 75 and change, just below 76. Isn't it a giant red flag that we've broken that multi-decade support? And again, we're wallowing around. Maybe there'll be a rally, maybe there won't, but you just don't break that kind of 35, 40-year support, and that's it. Then everything's fine and everything rallies and the dollar rallies. Typically, that means that there's a real breakdown, as you said, in front of us, which sort of goes along the theme that you have over there, that there really is a currency crisis directly in front of us, correct?
That is very significant in technical terms. We do utilize some technical analysis at Federated Prudent Bear. I also found it interesting that last week gold broke out both in dollar, yen, as well as euro terms, and I feel like that's pretty significant.
How about then the gold and silver markets? Where do you see those markets headed? Because I was interviewing Bill Fleckenstein about this, and he had written a piece, something Monopoly Money, but he was talking about the amount of fear that's in the gold market. And it's basically that it's climbing a wall of worry. And then on top of that, meaning there's so many gold people that have been shaken up for so long, and they've had so many bouts of downdrafts that even a lot of the gold community seems to be waiting for the next shoe to drop. It is climbing a wall of worry. And then on top of that, you have talks of a gold bubble, which are patently false and absurd, are they not?
Well, there are a lot of speculators that are buying gold. There's some positive sentiment for gold. However, in terms of individuals, we don't think there's many individuals at the household level buying gold, and therefore we don't think we've reached bubble proportions yet. Someone else related to me that he believes gold is one of the most likely commodities to experience a bubble, and I do think that's true. Now, also what we have is we have a global world's reserve currency breaking down. We have currency disarray around the world. We have countries that do not want to see their currencies appreciate because of rising unemployment everywhere. So this is a unusual time, and I don't think you can look at the traditional statistics about how overbought we might be and what the sentiment levels from speculators are to indicate the longer-term direction for gold. These macro factors are so gargantuan that we believe that gold can go a lot higher. Now, will there be ebbs and flows between here and then? Certainly. And we wouldn't be surprised if gold broke down back to below 900 at some point. However, we also wouldn't be surprised if this is the beginning and there's more and more talk about global currency moves and what we're going to do with the U.S. dollar. And these moves are taking a while to play out. And if gold isn't on a race, as you said, even though it's on a wall of worry, up to $2,500 over the next 2 or 3 years.
Where are we now, David, with regards to the banking sector, would you say? Can you give me an idea what you see going on there?
In the banking sector, there's been a great deal of moratorium so far in terms of foreclosures. We believe that there are as many as 7 million homes that are in the delinquency pipeline. Great article in Barron's and Alan Abelson's column, September 28th. Consulting firm has done a lot of work in this area, and they've been very accurate. And as many as 9% of those homes in that delinquency pipeline had not even paid any interest or payments for the last 2 years. We think that the banks are struggling. They are not really making new loans. We believe that the lack of mark-to-market accounting is allowing these companies to show better earnings than they otherwise would. They are generating some reported profitability from the loans relative to their low cost of funds. However, it's really fantasy accounting because they are not taking the losses they should have because they have so many worthless loans on their books.
You now have some bidding wars starting to happen on the real estate side and on some of these low-end properties that are bank-owned, and they're putting them out, I think, at prices that are sort of encouraging people to come in and maybe get into bidding wars. And so that'll have some transactional revenues to help the state coffers and the county coffers, and then the propaganda machine will try to use that to convince people that things are stabilized and back to normal. When you have a country printing its way out of a bad economy, what's the price tag for that, David? I mean, short term it looks good, but what is the reality for the U.S. on the longer term? Because there's a lot of confusion, I think, as the media machine is used to try to fool people into thinking things are okay.
Well, I think that the best answer to that, Eric, is just look at Japan. Japan burst their bubble in 1989. The Nikkei was at 40,000. They have piled on enormous debt over the last 20 years. They now have government debt amounting to 170% of GDP. Some expect it to exceed 200% of GDP this year. They have built every bridge to nowhere imaginable. They have provided quantitative easing. They've at least had the benefit of their country saved, and their pension plans bought their own JGBs, although that's at risk of running out shortly, and their savings rate for Japanese consumers is falling. They have not gained any traction at all. The market remains 75% below where it is. So this has been proved before that this massive money printing and creating stimulus programs is going to fail. The same occurred in the 1930s in the U.S. There was a quote from Morgenthau in 1937, 1938, Roosevelt's Treasury Secretary, and he said, "We've spent all this money, we've done all these things, and it's created no real traction in the economy." So we believe that the cost of this is essentially putting the entire country at great risk of funding crisis.